Welcome folks again to a new video tutorial. This is actually a lesson, and this is probably one of the most advanced lessons that I'm going to put in YouTube right now. So in preparation for the launch of the short gamma optimizer, I want to start covering ground for more advanced options concepts. And this is a lesson that is long overdue. I always wanted to do it, so I better get it out of the way right now. I hope you enjoy. Just a fair warning, the lesson could be pretty long, so budget some time for this. And also, it requires mathematics. The mathematical knowledge that this lesson requires is not very advanced, it's just normal algebra. So as long as you're comfortable with algebra, you should be okay. I'll try to minimize writing equations, but it is impossible. No, these concepts need to be explained with equations. Finally, another warning. I don't have a single chart on this presentation. So if you love charts, if you love nice little graphs, this is not for you because I didn't prepare a single one. This is pure theoretical discussion. I will be more than happy to talk to you on the Gamma Optimizer room or send me a message if you have questions. The reason I didn't do it is because I wanted to keep the number of slides really compact and also to keep the presentation short. And for every diagram that I put, I am going to take 10 more minutes for each of it. So hopefully this will be like a nice appetizer for advanced concepts. I plan to do even more advanced later on, but right now let's stick to this. I'm going to talk to one of the most fundamental concepts in options, and that is called the put-call parity. The put-call parity is a very fundamental concept and opens the door to pretty much all of the advanced stuff you can do with options. So this presentation will cover the basic review put-call parity and then all of the consequences that it brings, including spreads, synthetics, conversions, and boxes. So just let's start and see where we go. As usual, this lesson is all improvised. I'm just basically starting this from my head, no scripts. Let's start with the basic. What is put-call parity? Okay, so for option pricing theory, there are all sorts of rules to come up with the correct prices of options, and probably the most basic rule is put-call parity. Is what it is called as a no arbitrage rules. Pricing options is a field that uses a lot of rules, and all of them are based on the concept of no arbitrage. You should not be able to get a free lunch from the market ever, not with options, not with anything. So option prices tend to obey those rules all the time because no one wants to give away a free lunch. So and put-call parity is the most basic one. What does it say? What does put-call parity say? Put-call parity says that the price of a put option is not random and is not free from the price of a call option. So a put option with a certain strike and expiration and the same call option with the same strike and expiration, they are connected. Just for the fact that they have the same strike and the same expiration means that call and that put are connected. Therefore, the prices from those two cannot deviate from a theoretical framework. That's put-call parity. So if the price of the put goes up, the price of the call has to match it. And if you discover a violation on that relationship, that will be a free lunch and it should not happen. Why should puts and calls be connected? After all, they are completely different things. Puts will make money if the underlying falls, and calls make money if the underlying goes up. How is there a connection there? Well, I am not going to explain it in detail in this presentation, but if you look at the pricing options tutorials, you will see the connection there. Even though it's not explicit, it is there. The reason is that options are replicated with a portfolio. I mean, you trade options, but you should wonder, like, what does an option dealer do to offset the risk? I mean, if you arrive to an option dealer and I say, I want to buy the 2550 call for SPX, he will sell it to you. But the option dealer will not assume the risk of that option. He will have to be crazy to assume the risk of the option because that's not his business. The business of option dealer is not to assume risk. The business is to screw you out of the money, overpricing the option a little bit. So he has to offset risk in some way, and the way is done is by a replicating portfolio. So options can be replicated with just stocks and cash and bonds. So if you ever have curiosity how an option market maker works, it works like that. For every option that they sell, they get an equivalent position in stocks, cash, and bonds. And the particulars depends if they are calls or puts. But the important thing is that both puts and calls, sorry about that, use very similar underlying replicating portfolios, and therefore there is a connection between the two of them. Okay, let's stop beating around the bushes. What is the connection? So this is the connection. This is the formula for put-call parity. It is a formula. I am using this formula for European options. All of this discussion is perfectly valid for European options. For American options, you should change the equal sign for an inequality. So for European options, it should be exactly equal. For American options, it's kind of a limit. But for all practical purposes, let's say, equal sign. So the equation is this. The price of a call is equal to the price of the put plus whatever is the level of the stock minus the discounted strike. K is the strike. So this is kind of a very universal notation in options. Whenever you go over option literature, you will see S as the underlying price and K as the strike. Don't ask me why. I mean, I guess that goes all the way back to the original Black and Scholes paper from 1970 something, and that's kind of the convention they use, and that's the convention we use until today. So what does it mean? It means that you notice there is a connection between the price of a call and the price of a put. They are not independent. If you know the price of a put, you can know the price of a call, because the price of the underlying is known, the strike is known, and the discount factor can be also known. So the discount factor, don't let it be don't let this to distract you from the formula. The discount factor is kind of a little complex, but the discount factor is just the cost of carry for money, no? So remember, options expire at some time in the future, and money in the future is not the same thing that money in the present. So the put-call parity reflects the difference between the future and the present in terms of money. And if you remember your economics 101 classes or introduction to economics, you will recognize this discount factor. I am writing it here as a continuous compounding thing. So this is the exponential function, and those are dividends, and this is the interest rate and time. But it doesn't need to be if you are confused by it, just make d equals 1 and be done with it. In fact, for all practical purposes, the discount factor is almost 1, because we are in an incredibly low interest rate regime. So so R is very low, close to 0, and if the dividends are not that high, then this kind of thing is close to 1. The whole expression. It's not quite 1, it's a little less than 1. Now it's like 0.98, 0.98. So if you're curious on how to apply this formula for options, setting d equals to 1 is very simple, in particular if the time to expiration is small. So if you are dealing with weekly options or options that expire in just a few days, you don't even need to compute the discount factor. You just make it 1, and then the formula is much more simpler. So that's the put-call parity for you. Now the question is okay, wow, good to know. Wow, yeah, put-call parity. How is this even useful? Well, it's very useful. If you know this relationship, this thing opens the doors to pretty much anything you want to do. So let's see the easiest application. The easiest application, the most simple application of put-call parity has to do with in-the-money options. I don't know if you have noticed, you might have noticed by now if you have been trading options for a while, you might have noticed that the prices for in the money options are very weird. I mean, they don't seem to be correct at all, and in particular for deep in the money options. And most people lose a lot of money buying these kind of options because they are actually most likely overpaying for them. The reason is that first, option dealers don't like to sell in the money options. I mean, they are like, man, I don't want to sell an in the money option. And at some point, I will record a video why. But it has to do that with the fact that in the money options are really hard to hedge. Or not hard, I mean, all of the options can be hedged. It's just that, let's say, they are more expensive to hedge. So in the money options are more expensive to hedge and requires more kind of capital on behalf of on the part of the option dealers. So option dealers don't want to deal them, but sometimes they are forced to deal them. And also is because in normal trading, the amount of in the money options trader is very small, like it's very infrequent. Out of a volume of a very liquid option change, very few of those trades will be in the money. So most of the action is out of the money. So market makers have the software tuned to provide quotes for out of the money options all the time, and because of that there is more liquidity on the out of the money side, and because there is more liquidity, the bid and the ask spread is smaller, and the prices are tighter and nicer and updated in real time. However, for in the money options, those prices might be from 2 days ago. If you really go deep in the money, you can see prices there, like quotes that have not been updated in days. And those are just peculiarities of the whole market maker model. So then this is a situation. Then so for some reason, let's say that you have to deal with in the money options, but you don't trust the price at all from your broker. Like really, and in general, never trust the price that you see for an in the money option. Never ever. It's more likely that price is completely wrong. So what can you do? Well, because now you know the put call parity, you can compute the correct price. So if you want to know for instance, the most common problem is buying in the money call. So that's in particular for index. If you want to buy an in the money call for an index, it is a pain in the neck. So the only thing you have to do is just use the put. So the beauty is that if the call is in the money, the equivalent put to the put at the same strike is actually out of the money. So it's liquid and it has nice quotes and tight bid-ask spread, and the price is actually real. So if you know that with that put, just come here and you know what is the level of the underlying, assume d equals 1. I mean, just assume it and compute it. And that's kind of like gives you an idea of the cost of the call, and that's what you can bid for it. You can start bidding that for it and see that finally a market maker, someone is bidding for this, let's update the quotes, and they decide to update the quotes, and they might take you on the trade. So that's one a really cool application of put call parity. It is also very helpful for people like me. I collect huge amounts of data, of historical data from minute to minute, tick option data basically. So I know that all of those, most of those in the money options data is wrong, completely wrong. So if I'm doing some kind of a statistical analysis or doing like really advanced mathematical analysis of the data set, I know that the prices for those options are incredibly noisy. I'm using their rubbish, as our British counterparts will say. That data is useless. You can just throw it away. So what I do usually is I just basically discard all that data and reconstruct that data from the equivalent out of the money options. I have like really complex algorithms that do that for me, and that's one way to clean up the data. If you don't do that, you will arrive to amazing conclusions about the market, but they are mostly just because the data is wrong. So first application of put call parity is to correct wrong quotes for in the money and deep in the money options. Well, that application is fun, but it doesn't, it could save you some money, of course. Yeah, it is a money saving application. Please just run a quick sanity check. The equation is very easy to evaluate by hand. You don't need not even a calculator. If the option is in the near term, you just assume d equals 1 and kind of like give like a quick back of the envelope computation and see if market makers are trying to steal money from you or not. But so the question is, are there any more advanced applications for put call parity? And the answer is yes, there are plenty of more advanced applications. So before moving into those properly, let's talk about the implications for spreads. Okay, so there is an interesting implication when you do option spreads, in particular, or any option spread, verticals, calendars, butterflies, iron condors, you name it. Anything that is spreading options, we are buying and selling options, is affected by this. And one of the effects, which is very counterintuitive, and I have seen people on my trading room struggling with the concept, is like all of them, pretty much every member of the room struggles with this at some point or another, is that the spreads can be executed with puts or calls, and it doesn't matter. And this is something that is hard for people to wrap their head around it. Like, what? What way don't matter? I mean, calls do something, puts do something else. Like, yes, on their own they do something else, but once you spread them, it really doesn't matter. They are the same thing, and it's because you have this put call parity here. You can swap them, and nothing will change. So I have an example here. The example is a vertical call spread in SPX expiring this Friday, and it's just basically a bullish spread that is betting that the market will end up higher than 2,550. So you could execute, this is the classical spread you could execute. You could just buy the 2,545 call and sell the 2,550 call, and you get your nice vertical spread. But you could just swap the calls, put puts on it, and it's exactly the same position. Exactly. There is no difference. Don't fight it. Don't go. Well, I mean, if you're curious, I encourage you to go to your software, to your broker software or whatever is the software that you use to model positions, and model it, and you'll see that they're exactly the same position. What is the difference? Well, there is a difference. The first position is a debit, so it costs money to enter the position, and in the second position is a credit, so I get paid for the second position. So right here I just have destroyed one of the myths that I read all the time. I read it and I kind of like sigh when I read it. There is no difference between a credit spread and a debit spread. There is no difference. The difference is that one was executed with calls, the other one was executed with puts. I mean, in this case, these calls are out of the money, therefore this is a debit, and in this case, the puts are in the money, therefore this is a credit. That's it. That's the only difference. But the behavior of the spread is exactly the same. There is no such thing as an advantage, a theoretical advantage on using credit spreads versus debit spreads. There is, because they can be swapped back and forth easily. So let's explain why. Don't take my word for it. Like, I'm telling you that they are the same, but you are wondering, like, wow, is Leo correct? Why should we believe Leo? So just let's think about the problem. I'm going to pose the question to you: should both spreads have the same cost? It's a fair question. If I have those two spreads that theoretically behave the same, should they cost the same? So the question can be answered very simple. What is the payoff of this trade at expiration? We don't even worry about like mathematical modeling of this. Just look at expiration, which is very easy. So if you notice, if SPX ends above 2,550 on Friday, both of those trades will pay the max payoff, no? Which is $5. Why? Because in this case, both calls will be on the money, no? And both calls will be in the money, and the difference between the two is 5. So the profit of this trade is the $5 you got minus the premium that you receive. No? The premium that you pay for it. So that's the profit. And in the case of the puts, both puts will be out of the money. No? They will be worth zero. But you will get to pocket the credit that you receive at the beginning. And both of those payoffs are exactly the same. They could not be different. So the profit from this trade has to be the same. Otherwise, you get a free lunch. And I am going to let it sink. Think about it. Why, if for some reason the payout is different, because of the cost is different. If the payout is different, how can you get a free lunch? That was, silence, so you can think about it. Well, the reason is, if one of these is paying more than the other, then the only thing you have to do is you sell the one that is paying more. Like you instead of buying this, for instance, imagine that this is the one that will pay more at the end. Then you sell this one and buy this one, and then you pocket riskless profit, because you are establishing you are basically offsetting the position, but one of the legs is delivering more profit than the other. Therefore, you pocket tremendous profit without any risk. So, because of this arbitrage that is present, the spread should cost exactly the same. The total cost of the trade should be the same when you compare it. So of course, in real life, when you go and check these spreads, you'll notice that there are slight differences. There are a few cents differences here and there, and the differences are mostly caused by the in-the-money legs. So in this case, for instance, those puts are in the money. So you remember that I told you that in-the-money puts are weirdly priced. Any in-the-money option is weirdly priced. So there is a source of pricing differential there. And the other is that there is some kind of market microstructure to the out of the money. The out of the money spread is easier to enter than the in-the-money spread. So in that sense, there is an advantage to it. So the cost is slightly lower to entice people, but not by much. I mean, it's nothing that you could exploit. The difference is much less than the cost of your transaction cost, so it will be impossible to exploit. However, sometimes the pricing as quoted can be really, really far off. So when in doubt, when you really want, for whatever reason, buy the credit version, when you want to use the credit version of the trade, just for sanity check, just check the pricing of the debit version. So check always the pricing of the vertical or the option spread that has the out of the money legs, because that's the correct pricing. Anything else, the money legs never trust that pricing. Okay, so we are out of the way with option spreads. Why it doesn't matter if you use puts or calls, and why there is no advantage between from a credit spread versus a debit spread. And now we move to the real meat of the presentation. Put call parity opens the door to very interesting trades. One of the most interesting trades, or the basic building blocks of put call parities, are called synthetic trades. What is a synthetic? A synthetic is an option trade that behaves exactly like the underlying. It is the way of buying an underlying, but with options. So instead of going and buying the shares, you go and do a synthetic trade, and you have exactly the same risk, exactly the same. How can this be possible? So this could be possible because if you remember the equation, the only thing I'm going to do, I'm going to move the put to the left side. So if I do that, then I get this. I get the call minus the put is equals the underlying, the price of the underlying minus the discount times the strike. So that equation, when you write to that equation, like, I don't see anything there. But let's rename this term as the synthetic. And let's just ignore this. This is a constant for all practical purposes. No, it's not quite a constant, but imagine that interest rates will be constant during the life of the trade. So in that case, this term is a constant. So I can write the equation as this. Synthetic equals the stock plus a constant. And if you notice, what is this equation? This is just a straight line. This is a straight line with a slope of 1. This is the slope of this thing. So basically, my synthetic is just tracking 1 to 1 the underlying. That's exactly what the synthetic is doing. So what is the synthetic component? Synthetic is C minus P, is this part. So what is a synthetic trade then? How do you implement a synthetic trade? From the equation, a synthetic long basically is just a short put and a long call at the same strike. So whenever you sell a put and then you buy the call on the same strike, you are entering in a long synthetic trade. And that trade is equivalent to a trade on the underlying. That's what it is. So why would you want to do that? No, that's a good question. Like, why would you want to like sell options instead of just buying the shares? That's a fair question, and I will say you are right. If you can buy the shares, just buy them. It's easier. But the synthetic can be cheaper. That's one of the reasons to use a synthetic trade is that it's cheaper. Look at this. This is an example of a synthetic put for today. A synthetic trade on SPX for today. The only thing you have to do is sell the 2535 put and buy the 2535 call for the same expiration, and this position will track SPX 1 to 1, point by point, until expiration. That's what it is. And I picked this strike kind of close to the at the money value where SPX is, but it doesn't have to be. It can be any can be any strike you want. Really, the strike doesn't matter. It could be any strike you get a synthetic. But if you do it at the money, there will be an advantage you will see later on. So yeah, a synthetic is nothing weird. It has a fancy name, I guess, but the trade itself is very simple. No, in fact, for the members of the gamma optimized room, this looks like a risk reversal where both of the strikes are the same, and I will say yes. Synthetic is a particular case of a risk reversal, but in this presentation we are not going to talk about risk reversals yet. So the synthetic trade on its own is kind of curious. It's a curiosity, but it's not that useful. I mean, what is the use of a synthetic trade? I don't know. I mean, you could just, instead of doing this, you could just buy futures, or you could just buy SPY shares. Why would you go to the trouble of having margin on this short leg? This short leg will produce like heavy margin. But as you will see, there are interesting uses for synthetics, not on their own, but mixed with something else.